Hi everyone, I'm Tim Perotti. I want to talk today about factor investing. Factor investing has become popular among investors as a way to generate returns. Factors are characteristics of a security that helps explain its risk and return profile. Factors are diversifying from each other in ways that can help manage risk and generate alpha. No single factor consistently outperforms the others, as they are not highly correlated with one another. The major factors are quality, momentum, value, size, and volatility. Let's start with the quality factor. Quality is the factor used to describe companies that have higher profitability with more stable cash flows, low levels of leverage. Quality companies typically have strong corporate governance. Historically, these companies have outperformed over the long term. Momentum. Momentum seems straightforward, but it does generate returns. Momentum is used to describe stocks that have outperformed recently, tend to continue these strong returns in the near future. The goal is to capture stocks with rising prices. Value. Value investing targets companies that are underpriced relative to their intrinsic value. Warren Buffett is one of the most well-known value investors, as this strategy finds companies that are trading at a lower price than they are really worth. The size factor. Size shows that small cap stocks generally have higher returns than large cap stocks. Market capitalization is the difference between the two strategies. And volatility. Volatility factor aims to target securities with low volatility as they generate greater risk-adjusted returns than higher volatility securities. So quality speaks for itself. In the kind of high volatility environment that we're in right now, certainly the quality factor makes a lot of sense. Momentum. Think last year. Think of a market that just continues to seem to want to work. Those are the kind of tapes where you might pick a momentum factor as really more of a trading vehicle in my mind than a long-term vehicle. The value factor is interesting in that value has underperformed for so long that it's hard to find value investors out there because momentum is really what has worked. But as we go through more difficult markets, you probably have a lot more downside protection in the value factor. Size factor, again, you're talking about where do you want to be on the risk metric. The IWM, the small cap type indexes, where most smaller cap companies you're going to see, is going to have more volatility and probably more downside risk in a higher volatility environment. But in an upside environment, smaller caps are going to probably offer you more upside. The volatility factor, as I said before, focuses on stocks with lower volatility. So again, if you're in a market where you're afraid of rising volatility and potential downside, you want to use a volatility factor to find companies that are more defensive and tend to hold up better in downdrafts in the markets. So smart beta indices are utilized in the annuity market to try to take advantage of these factors to help drive returns and diversify. So if you're interested in looking at annuities and annuities based off of some of these factors, let us know at WealthVest.